My name is Renate Günther, and I have the pleasure to be the Vice President and the co-founder of the Geneva Marco Labs. And I will be moderating this online talk today, together with our co-founder and our President, Dr. Eckhard Ernst. For those who don't know the Geneva Marco Labs yet, we are a do tank that combines a research think tank with a multi-stakeholder exchange platform to leverage the unique institutional, financial, and human capital of the Lake Geneva area and beyond. We bring leading minds together from the public and the private sector, as well as from civil society, for example, through this weekly webinars to help achieve SDGs. And together with our community, we develop new insights to co-create opportunities for action, given the complexity of tasks ahead of, like this current pandemic, a situation where quick fixes do not exist and where we can't rely on yesterday's best practices only. So what's on the agenda today? We have two presentations. COVID-19 impact on remittances into low-income and fragile states by Dr. Ralf Charmi from the International Monetary Fund, and central banks' responses to the pandemic by Dr. Thomas Moser from the Swiss National Bank. And that will be followed by Q&A and the usual open discussion. So please feel free to comment and post your questions into the Zoom chat tool already. You can find the chat tool on the bottom of your screen. And also please mute yourself if you're not presenting in order to avoid possible background noise. And this webinar will be recorded so that you can review it in case or send the link to your network. The video will be available later this week. Before I hand over to the first speakers, I have a question for all of you. In which country are you currently located? Please comment in the chat tool because we want to understand how international our audience is. Thank you in advance. I have the pleasure to present our first speaker now, Dr. Ralf Charmi. Ralf is currently Assistant Director in the Institute for Capacity Development at the International Monetary Fund. And Ralf has a forthcoming book, Macroeconomic Policy in Fragile States, which is being published by Oxford University Press. From 2009 until 2014, he was also Division and Mission Chief for Low-Income States and Fragile States in the Middle East and Central Asia Department at the IMF. Ralf is also the recipient of the IMF 2014 Operational Excellence Award for his field work on these states. And I can confirm Ralf's excellence. He was speaking at our Davos event earlier this year. And in 2019, he was also a guest at our conference at the UN in Geneva. And I look forward to his presentation now. Ralf, may I ask you to unmute your screen, to unmute your microphone, and share your presentation.
Thank you, Renate. Can you hear me?
Yeah.
And can you see me? Okay, so we're almost there. Well, thank you so much, Renate. Thank you, Eckhard, and thank you all for the invitation, all for showing up. But I have about 10 minutes to do this, and I'm going to try to share my screen, so bear with me a minute. Does it show?
Perfect. Just put it into presentation mode.
It says I'm sharing the screen now. Is it sharing?
Yes, it's sharing, and
okay.
Just put it into presentation mode.
Okay, all right. All right.
Perfect.
Okay, we have a go. All right, so what I would like to talk about today is something that's in addition to what's going on in the world due to the COVID crisis. It's something that I would term is unintended and perhaps unnoticed channel of transmission of the COVID crisis across the globe, and in particular to the most fragile and the most vulnerable among us all, which are the low income and the fragile states. And the culprit in all of this is, strangely enough, are the remittances, which are typically viewed up until now as a lifeline for these countries. So where does the story start? Okay, let's start with migrants across the globe. And according to our colleagues in ILO, there's about 165 million migrants migrant workers, excuse me, that are distributed. Perhaps majority are male, about 60%, and most of them you find them in high income and rich countries. And these migrants, they help the economies of rich and high income countries. At the same time, part of what they gain in the wages that they make send home to their families back home. Typically would be like $50 a month, $100, $200 a month, but they do add up. And according to our colleagues at the World Bank, in 2019, the total amount of remittances to these countries, low and middle income countries, including fragile states, is about $550 billion through formal channels. A lot more goes through the informal channels. So they're quite sizable and they're quite important, and migrant workers send them home to help their families back home, especially in times of need. And when we look at, in terms of all the flows that flow into ELIX, here means low income countries and fragile states, you find that the blue line here, that the remittance flows, these are private income flows, person to person, dwarf all other flows, including FDIs, including official development aid or portfolio flows. Because of their volume, because of their frequency, and this thing on the right-hand side, because of the low volatility, meaning they're very stable, okay, relative to every other flow, countries have come to rely on them. Households back home have come to rely on them. Even governments have come to rely on them. And they've grown to the point that in some countries like Tajikistan, they're about 40% of GDP. And these are just the top 10, but a lot more countries receive remittances between that number and 5% of GDP. And there's about 100 countries that do so. So they're quite reliable. They're viewed as reliable and they're viewed as stable. And this is just a quick, sort of a highlight of what do households do with this money that they get from relatives abroad. Typically, they use them to increase their consumption and to buffer their consumption against shocks of all kinds. They use them also to spend on healthcare. They use them to educate their kids. If they have a project or they have issues that they need money financing, it's a cheap source of funding because it's coming from the relative. So they really don't need to go to a bank to do so. So it alleviates credit constraints. And they use that money sometimes to start businesses. So it increases their self-employment and or to choose to engage in informality rather than joining the labor force. Okay, so the question now is, well, are they still stable? Are they still reliable during this crisis? And I've been working on this for 21 years, 22 years. I tell you, I've never seen anything like this. This chart comes from our colleagues at the World Bank. That's in the latest report. And according to the bank, in 2020, remittances would drop by 20% relative to 2019. That's a $100 billion drop. But what is even more worrisome than this, that they're dropping at the same time as everything else is dropping. This is FDIs are dropping, portfolio flows are dropping, and perhaps even ODA will, coming from the rich countries that are now facing the crisis themselves, is at the risk of dropping. So in a sense, it looks like the perfect storm for these countries, because typically what I would have seen, what I saw in 2008, for example, despite the fact being a global crisis, is as FDI tanked, as portfolio flows tanked and so forth, remittances still trickled in to offset some of the damage done by the outflow of capital. But not this time around. It looks like all of them are actually leaving at the same time and the remittances are not coming in. So what would be the impact on households? Well, just as the households, people back home were using this money to get themselves out of poverty, increase their consumption, there's going to be a drop in consumption. There's going to be reduced spending by them on public health care, on education. They may need to borrow money. Question is from whom? The banks already in these countries do not necessarily lend to the poor people in the countries, or don't even lend to the private sector for that matter. So what they may need to do with all of this shock to the household may find themselves having to go out and seek employment or even accept underemployment. What are the implications also for the governments? Well, the governments have gotten used to this stable source of funding, and governments have figured out that they don't want to tax remittances directly, so they usually tax them indirectly through value-added tax, sales tax, trade taxes. But they're going to find out that when households reduce their consumption due to the drop in remittances, the consumption base is going to shrink. As a result, the tax the tax base is going to shrink. And at the same time, the governments are going to face increased spending on public health. Yeah, this is over and above what they're going through right now. This is just the effect of remittances themselves. They're going to find out that this cheap source of funding is drying out, these precious dollars or rubles, what have you, coming in. And as a result, governments are going to find that the debt services, the cost of debt service is going to go up. And we always say, well, countries should engage in counter-cyclical fiscal measures during tough times. Where's that money going to come from? Because those governments have relied on remittances and are not going to find them. So governments may have to borrow just to adopt the counter-cyclical measures. But the effect goes beyond that. You see, when you send money home to help your family, you intermediate it through the banks. Banks have also figured out that this is a cheap source of funding, because when I send money home to my mother, I'm sending it because I care about her, not because I want to make money. So for the banks, it's the deposit that comes into the account is a cheap source of funding, okay? What now, there's a drop in that cheap source of funding, drop in remittances. As a result, it's going to impair their ability to lend, which means it's raising the cost of funding for all borrowers, including the government or the private sector. It will surely have a negative impact on bank capital, on bank stability. There's a monetary policy implications for these countries, because many of these countries that receive remittances, sizable amount of remittances, they have fixed their exchange rate. Well, guess what? With the reserves dwindling, because remittances are dwindling, on top of everything else that's happening, there are devaluation pressures, and for those countries that don't adopt fixed exchange rate, there's depreciation pressures. However, the sad thing about this is you're not going to get the benefit of devaluation or depreciation, because typically we think, well, if the currency were to depreciate, maybe exports would be helped, but who's going to demand those exports? If your currency becomes cheap, there are no tourists coming, because the tourists in the other countries are also their incomes are being hit. So you're going to just get the depreciation, which is going to have a very bad effect on the economy as a whole. The effect goes beyond that into the labor market pressures, okay? For households that have received remittances and use them to get self-employment, they're going to find out that that funding to start those jobs is dried up, is gone, which means they're going to lose that ability. They may lose their jobs. Females always suffer more in these circumstances, and you're going to find out that people are joining the unemployed, standing in line. These are countries that already are brimming with unemployment among the youth. All of this put together is going to put severe social pressures on the governments. If this is not enough, look at this situation. Many of these migrants in the rich and well-to-do countries, that once they lose their jobs, they also lose their residency. And not only that, even when they're living in these high-income countries and rich countries, their housing conditions are quite dire, which means the rate of infection among them is quite high. So now you lose your job, you lose your residency, you could be infected, and now you're going home. You're going home to a country that's already reeling from the crisis, trying to take care of the residents of its own people there. And now the migrants are coming back and they could be infected. And also looking for a job. All of this is going to put tremendous pressure on the country itself. So it's going to perhaps lead to underemployment, unemployment, increase in informality, working poverty. The economy would shrink. There's a rise in social pressures in countries that are already fragile and having a hard time at it. So there's something I call boomerang, because it doesn't end here. These situations within could easily spill beyond the borders of these recipient countries if we don't do anything about it. And now you may face a new and more intense refugee problem, but this time around the narrative is quite different, because the rich countries now are themselves under attack from the virus, and they're looking inward themselves, so there's less space to be acceptable of new refugees that are going to be knocking on their doors. So what is it that we can do right now? Right now, what is it that we can do to avoid or at least mitigate the situation? Well, so I broke it down into what can host countries do, meaning the rich countries and high income countries. What can they do? Well, these migrants have been in our countries helping our economies. Just as we now turn around and come up with all these packages to protect our citizens, we should extend that protection, be it in the paycheck or the employment or in social protection, to the migrant workers. And perhaps it's high time that we do something about improving their accommodations rather than having 20, 30, 40, 50 of them to a room. We should really, you know, get a bit more humanity into this discussion and improve their accommodations. Also, the cost of remitting has always been high. We have an SDG 10, which talks about reducing the cost of remitting to 3%, and we're nowhere near that. And perhaps we may want to get serious about this, because that's one way of how we can help the migrants continue to send, no matter how much money they are still making back home, at least during these tough times. What can IFIs, as international financial institutions, what can they do? Well, what they do best right now, they're engaging in countries we're providing financial help, technical help, capacity development. We need to do a lot more for these countries that receive remittances because of this additional channel of transmission, that they're going to be in even worse situations. So financial assistance in terms of budgetary assistance, in terms of balance of payment assistance, capacity development, technical assistance remains very important, including helping those countries dealing with the return migrants, the quarantine, and all the testing that is needed, okay? So one thing you want to take from this discussion is that we are all in this together, okay? We're all in this together. These migrants are in our countries. It's best that we help them while they're in our high income and rich countries before they go back and come back as refugees. Let me stop here. Thank you.
Thank you so much, Ralph. I understand what countries can do now to mitigate the crisis and help the migrants is to reduce the high cost of remitting, also to ease the economic burden that the pandemic caused. We now have the chance to listen to Dr. Thomas Moser. Thomas is an alternate member of the governing board of the Swiss National Bank. He has previously been an executive director at the IMF in Washington, DC, as well as Ralph. And he holds a PhD in economics from the University of Zurich. At the Geneva Macro Labs, we already had the pleasure to listen to Thomas in 2019, where he spoke at our UN conference. Thomas, may I ask you to unmute your microphone and share your presentation? You have the floor.
Thank you very much, Renate, and thank you very much for having me. It's a pleasure to be back with Geneva Macro Labs. And I will talk about the response of the central banks to the crisis. And now I have to... Okay, I think we're good now. Except that I'm at the wrong end of the presentation. Okay, so as I said, I talk about the central bank's response to the crisis. And when in Geneva, even though only virtually, I thought it would be quite appropriate to start with a cartoon by Patrick Chapat. He's a very world-famous political cartoonist from Geneva. And he, of course, also had a comment on the most recent crisis. And here is how he sees this trade-off between health policy and the world economy. And while I would not quite agree that this trade-off is so stark, because I think you see in countries that didn't have a severe lockdown or a lockdown, for instance, Sweden, you also see quite a damage to the world economy. You also see a recession just because people, even if they are not forced to stay home, they don't like to go and risk their lives when they see that there is a virus out there that is causing death. So there I wouldn't quite agree that this trade-off is so stark, but where I clearly would agree with Patrick Chapat is that the world economy is really devastated right now. And Ralph has also referred to that we see now macro data coming in that is worse than what we have seen during the financial crisis 2008. And my point here will a little bit be that the good news, at least, is that when we look at the financial markets, at the stress indicators, the situation is not quite so bad. Even though we have some indicators that are as bad as 2008, most are not. And the argument I will make here is that this was mainly because central banks were successful in preventing this shock from generating yet another crisis. So last time in 2008, the central banks had to make sure that the financial crisis didn't cause too deep of economic crisis. This time, the shock origins in the economy now and is potentially affecting the financial sector. So that's the good news. The maybe not so good news is that I see this whole crisis to play out in 3 stages probably, and we are now entering only the second third of this crisis. So the first part was basically what I would call life support. Governments had to do fiscal transfers, central banks had to provide liquidity, had to make sure that markets didn't dysfunction, that the transmission channel was not totally dislocated. So my argument here is that has been achieved more or less, and now we are entering the stage where we soon need, when we are opening up again, we need recovery, stimulus, and this might be, and I will say in the end why, a bit more problematic. And there is also the potential for a third stage of this crisis, namely then when we see that there is a lot of debt now generated, and how do we deal with that? Will there be a debt overhang? So when we talk about financial markets, of course, what always comes to mind first is the stock market. Here, another cartoon that shows the Fed injecting interest rate cuts to prop up the stock market. So while this was not the main concern of central banks, certainly also not at the Swiss National Bank, it was clearly quite impressive how the stock market reacted to this crisis. And you see here a comparison with the 2008 financial crisis. In gray, you have the reaction of the stock market. On the horizontal, you have the trading days since the beginning of the shock. And you see that in red, the current COVID crisis, that the drop in stock markets was even faster and even deeper than what we have seen during the financial crisis. But we had now, especially given the reactions of the Fed, a certain recovery. But we can see that here, at least, this compares not favorably with the financial crisis 2008. Also, if you look at implied financial market volatility, this VIX indicator, which is sometimes taken as a stress indicator for the stock market, you also see here that we are at levels that we have seen during the financial crisis 2008. Now, what exactly had central banks here to do? As I said, the stock market was really often it is portrayed as if that would be a main concern for central banks, but stock market really was a symptom. What we have seen is that the businesses, corporations lost revenue. It stopped in some parts because of the lockdown, while they still had expenditures, which put quite some stress on their cash buffers. And I think one thing also, for me at least, was interesting to see how small those cash buffers were of the corporations, and that might be something that will be different in the future. But so the businesses had to fund themselves to pay for their expenditures from financial market sources and from banks. And we talk here especially also about a lot of small and medium-sized companies that might not have had access to financial markets and had to go to banks. At the same time, you have banks that those especially who are not having a large deposit base, and this includes foreign banks that need dollar funding, that had to go to the financial markets, and there were also problems there. So you had a lot of funding stress in the markets, and that's where the central banks came in. So on the one hand, they had to intervene in the financial markets, address spreads, and on the other hand, make sure that the banks had enough liquidity that they were able to fund these loans for the businesses. And of course, you also had the government come in that launched guarantee programs to support bank lending to companies, and especially here again for small and medium-sized companies. Now, if you look again, a comparison with the financial crisis 2008, also a bit shocking here to see that if you look at banks' performance on equity and debt markets, that this is also quite similar with the experience of the 2008 financial crisis. Here, this is something that I took from a BIS paper. You see let's start with the black lines. You see here how bank equity performed in dots. That's after the Lehman collapse. Also here again, number of days on the horizontal axis, and then the dark black line, the COVID crisis, and you see that the banks basically the equities did as bad as after the Lehman collapse. And in blue, you see the CDS spreads, basically the price you pay as an insurance against default. You see that they also both increased as after the Lehman collapse. Now at the very recent data, you see there is an improvement, and I assume here that this improvement will continue. If you look at other market stress indicators, you see that they also clearly worsened during the crisis. You also see that the central bank action has led to an improvement, but we are not back to normal yet. But on these indicators, and here for instance, bond spreads, corporate bond spreads compared with government bonds, interest rate spreads, then you see compared with the financial crisis, this was clearly not of the same magnitude. If we go to LIBOR OIS spreads, that's often taken as a measure for credit risk within the banking sector, or also the funding cost of the banking sector. You see that we also had here, especially in the US dollar market, a significant increase in March, April. But again, if you compare that with the financial crisis 2008, we are not at those levels that we have seen back then. And here also an interesting indicator, the FX swap basis, which is an indicator of US dollar funding costs. And basically what you see here is a negative basis means that there is a dollar shortage especially for international banks and international investors. You have a dollar scarcity, and you see that that both compare against the euro, against the yen, against the Swiss franc, we all went clearly negative in March. And in normal times, you should be around zero because you can do arbitrage. But this arbitrage was not possible because it was just so difficult to get US dollar funding. But you also see that the improvement came especially after the central banks, after March 17, started their US dollar swap line auctions. And that led quite quickly to recovery. And here again, if you compare to the 2008 crisis, you see that it has been much worse back then. Now, and this is my last slide, as I said, we are going now into the second stage where a stimulus might be appropriate. And you see that the problem is here that the central banks and their policy rates, there's not a lot of room for stimulation. What you see here is the policy interest rates of the Federal Reserve in red, of the ECB in green, and of the Swiss National Bank in blue. And you see before the 2008 crisis, we all had significantly positive interest rates. They were all lowered in reaction to the financial crisis. But then you see that both the ECB and the Swiss National Bank not only stayed at zero since then, but even had to go negative in 2014, 2015. So the Federal Reserve was one of the few central banks who could increase interest rates, but now in reaction to the COVID-19 shock, they again lowered interest rates. And now this is, of course, not the best position to be in now going into the second stage of the crisis with interest rates being at zero or even negative. Okay, let me stop here. Thank you.
Thank you so much, Thomas, for the very interesting presentation and also your thoughts regarding the interest rates related to the COVID-19 crisis. I could see that you were all posting a lot of questions already, and I'm happy to hand over now to our President, Eckhard Ernst, who will moderate the Q&A. Thank you, Eckhard.
Yeah, thank you, Renate, and thank you to Thomas and Ralf for this excellent presentation and great insights that you shared with us tonight. As Renate said, I will handle the Q&A today. So we have around 25 to 30 minutes now for Q&A. And given that we already have quite a number of lineup of questions, I asked you to be very brief. I would like to bring in as many of you as possible into the chat. But we need to make sure that we kind of be concise and short with our questions. So we already have two questions related to Ralf's presentation and especially to to the fact on how we can identify, prioritizing these migrant workers. Garrett, do you want to ask your question directly to Ralph?
Yeah, sure. Thank you very much. Again, two excellent presentations, both very concise and informative. The question really was, how do we persuade policymakers now to support pro-migrant investments that Ralph was suggesting in order to mitigate the longer-term consequences, particularly in the populist anti-immigration regimes that we're seeing in various countries around the world? How do we get them to understand this argument and pay attention to the evidence when they haven't done so previously?
Thank you. Ralph.
Yes, can you hear me?
Yes.
I'm having difficulty with my camera, so but I understood the question. I think we want to start from the principle that, first of all, the whole thrust of my presentation is saying you either look after them in our countries right now, or we're going to be facing a much bigger problem in a number of ways, including a new refugee problem that's going to be far more difficult than the one that we're already dealing with right before this crisis. So that's one way of looking at it. I think we have to all understand one thing. I was listening, I find Thomas's presentation very interesting. I worked on the 2008 crisis myself, and I recall that when we had the 2008, the Great Recession, we still had Asia that was able to pull us out of it. Okay, so think of yourself like this. Okay, you're stuck in a river with a very strong current, and there's somebody on the bank throws you a lifeline, pulls you out. This time around, there is no one on the bank side. Everybody's in the water. We're all in the water. We're all holding hands. We're all treading water. We either swim or we sink together. I think that's a very important thing to understand. There's no one out there to help us out. So if we don't help the refugees, if we don't help the migrant workers in our countries, first of all, they are contributing to our economy. Okay, they do a lot of the work that the citizens do not want to do, and without them, the fields are going. No one is picking up the asparagus and the strawberries and so forth. Okay, so we either stabilize them in our economy. By stabilizing them in our economy, we stabilize their remittances back home, allowing people back home to still have some purchasing power, which could also help our exports into their countries. Not doing so can generate a what I call the multiplier effect, which can boomerang back to us in all kinds of different ways: social upheaval, social pressures within the country spilling out into neighboring countries, and then it's a much bigger problem.
Thank you. We had another question, and that was actually quite related to the first one. Was more like, can you identify some particular models that would help us to better communicate this? I think that what you mentioned already is certainly to the point, but maybe kind of in order to convince policymakers, what needs to be done specifically beyond kind of bringing this argument home?
Just for example, just as we are providing packages for our citizens, in the US, we had a $2 trillion package, right? Every American, I'm an American citizen, I presumably received something in the mail, right? A check. That, what I'm saying is that the migrant workers should also receive a check. They are contributing to this economy just like everybody else. And we need to stabilize them in our countries here. So this is a concrete action, but it's not only about giving them a check, it's also in terms of access to the social network, to the social insurance programs, because we need to look after their health here. Okay, so in many of these countries, rich countries, they're actually housed 50 to a room, and that's why the infection rate is high among them. And in some of these countries, which I do not want to name, they rely on these migrants for their economy. So if the migrant workers are ill, they're not going to be able to restart their economy anyway. Okay, so there are concrete things we can do. We can look at their housing condition now. If we want to help them also in terms of transfers back home, the cost of remittances, and our colleagues at the World Bank have done a lot of good work on this. ILO has done work on this. The cost of remitting, it remains too high. And part of the SDG 10 was always to push that cost down. And it's high time we do something about it, especially during, and this is something we can do. This is something that countries can do. So we're all in it together, okay? We don't really need another crisis, a refugee crisis, for us to wake up and say, oh, we should have stabilized them. No, I'm telling you, we can do this. We can do it now.
I think your last point is important on the cost of remittances. We come back to this because we also have a question in the chat, but I would like to first move to Thomas and see what central bank can do in this in comparison to the previous crisis. Robert, you wanted to post your question directly to Thomas?
Yes, hi Thomas. I was just wondering, if you could elaborate a little bit on the difference for central banks and policymakers and more generally in this crisis. What would you say is not different compared to the 2008 financial crisis?
Thank you. The big difference, I think, is where the crisis originated. So last time it was a classical financial crisis, and that is a core task of a central bank to act as a lender of last resort and provide liquidity to the banking sector. I think this time the difficulty was that the crisis originated in the real economy, and to get liquidity and funds to the corporation, that's much more difficult to do for a central bank. We deal with banks, and what we basically had to do is to make sure that the banks had the liquidity to provide then the funds to the corporations, and to make sure that the financial markets continued to work, that the corporations could fund themselves in the market. So that I think was much more difficult to get the liquidity to where it is needed, because we are not really equipped to do that.
I think Serge had a question on that particular point and his concern about the long-term implications. Serge, do you want to come in this respect?
Yes, hello. If I'm the only Serge, by the way.
Yeah, you are.
Okay. No, I mean it's a global storm about everything at the same time. But the COVID is maybe only the how to say in English, the last straw on the camel's back. Because to be honest, and sorry for you, Mr. Moser, but after 2008, the central banks were not able to map up of that liquidity and everything. Nothing came back to normal, by the way, and especially salaries were not. I don't want to do more economics, but it looks like it's trouble everywhere, and maybe. To what extent can we avoid the full reset? Because now inflation is in assets, it's crazily high. Look at the S&P 500 today. It's like fantastic. And at the same time, 30 million people have no job in the US. Sorry, also to Mr. Shami, but it looks like, and hedge funds accessed to 12 billion of the funds which were earmarked for small businesses and so on. Maybe there is also a problem with governance here. And it looks like, oh la la, it's a perfect storm. And the question is, how can we avoid that this huge amount of liquidity how are you going to mop that up, knowing that the world is in very dire strait? Sorry, thank you.
Yeah. No, I mean, it's a good point, and let me also be clear that I fully agree also with the points Ralph made. First of all, this is very difficult, and as you said too, this is really worldwide. There is no one is spared this time around, and it's also very likely that the low-income workers are the most affected. I mean, people like me and probably most of you, we work from home. A little inconvenience, but not really a disruption, while people who rely on services, on face-to-face services, they are really the ones who lost their income. So there is also a risk that the inequalities that we have seen grow, that they will actually increase further during the crisis. Now on central banks, as I said, I mean, I didn't declare full victory. I said just the first part was really to make sure that this does not lead to a renewed financial crisis. And I think at least this first stage has been successful in that. Now you talked about the the aftermath of the financial crisis 2008. I mean, there are two things to say. One is clearly, as you also say, what probably surprised at least most people is that we never had a full recovery to the old growth path after that last crisis. The economy really went into a much lower growth path. So we have been losing since compared to what we would have had probably without that crisis. And second, as you said, I mean, the central banks have been lowering interest rates, and as I showed in the last picture, we have not been able to increase interest rates again. Now, the argument I would make here is that that there has also been a shift in the equilibrium interest rates. I mean, that's the argument we have been making in many central banks, that there was not really. You say we had asset price inflation, so that might be one argument you could make. We clearly didn't see anything in consumer prices, especially not in Switzerland, where we even had for a large part negative price increases. So if you have a shift in the equilibrium interest rates downwards, that now the new world, the new normal, so to say, is to have much, much lower interest rates, which clearly constrains central banks. But that could also explain why some of the valuations of asset prices increased, because that would be a new world with very low interest rates, and that's not a comfortable world either, with a lot of problems. And also one is, as you mentioned, I think alluded to, is the increase in debt that we have seen, especially also corporate debt. And those corporations that have issued most of the debt are not the top rated corporations. We have now a very just barely investment grade corporations that have issued most of the debt. And of course, now with this crisis, additional debt, outlook not being too great, there is also a risk that they will be downgraded. And that's why I also said there might be this third stage. So we are clearly not through yet, and it's not a very comfortable situation to be in.
Thank you very much. Indeed, I'm very fearful about the rest of the year, and especially 2021. Thank you very much.
Thank you, Thomas. As we have quite a number of tech experts in our community as well, there's obviously a huge interest in kind of finding technology solutions to the remittances problem that Ralf mentioned. So maybe Anthony, if you can unmute yourself and ask the question directly, or what you had in mind.
Yes, sorry. My question is to try to enhance international money transfers worldwide by integrating new technologies. The cost of money transfers through the existing players are very high, from 4 to 15% based on the amount sent. So using like digital currencies or coins will help us to reduce I would say, significantly the cost of transferring money. And it will be even more easier to transfer money instantly, immediately. So the question is, first, how can we find a way to educate people to use this new technology in these countries? To my understanding, even poor people, everybody has a mobile phone. And in Kenya, from 2013, they are using the mobile phone to transfer money in all the country. So there are some success stories, and we should think about, I would say, a worldwide way to help these small community of migrants that are sending the money to their home. So the question is how we can try to do the transfer from our old archaic system to a new technological system. This is my question.
Thank you. Ralf, if you want to go first, and then Thomas, if you want to come in as well.
Sure. I mean, certainly fintech, digital finance, all these new technologies are helpful, and certainly their time has come, because if anything, aside from they themselves, there's value in the fact that they do things faster, and you're taking out the intermediary, and so the cost is actually lower. They also provide competition to the MoneyGrams and the other types of, basically saying, look, if you don't lower your fees, then people are going to move to to these alternative platforms. I think the alternative platforms time has come. In many of these fragile states and low-income states, actually mobile technology is the way to go. So then the question becomes, how do we make inroads into these things? First of all, remember that the money is coming from the high income and rich countries to the fragile. So the education has to be done on both sides of the ocean. For the migrant communities in the high income and rich countries, they have to know that these technologies exist. I know some colleagues that are working on these things from a research point of view. And I think that's, so there's the idea of disseminating that information to the migrant communities in the rich countries that, hey, you could use these new technologies to do so, okay? And I suspect some things are taking place. I understand of different technologies are in hand. There's also a regulatory issue that you have to be aware of. There's an AML-CFT issue that has to be resolved. And I think that has been kind of delaying some of these issues. So perhaps now is the time to discuss these issues within the governments that are concerned about how that money could be used or misused. I just want something else in terms of these issues. I read the other day, hopefully I'm not misquoting, that Germany is open to the idea that Eurobond being used for the pandemic. If my reading is correct, that's actually a kind of also a financial way of allowing countries to use Eurobond, in order this sharing of the risk, in order to be able to borrow, in order to be able to, especially for the poor and fragile states, to get that that kind of association with the strong IOU, in order to be able to get the funding needed in order for them to be able to fight the pandemic in their own countries.
That's actually a very interesting point. Maybe Thomas, in your answer, you can reflect on that point as well, especially the Swiss perspective on the recent proposal that Germany and France has put together. What's your view on this?
I think that was really helpful also, as you could see in several of the financial market reactions. That was taken up very positively and would clearly be a step forward, because there is quite a burden to share. And I think it's an old story. In a monetary union, you need some fiscal transfers and sharing to make it work. So I think it's a step in the right direction. Maybe just one, if I can add one point on the fintechs, and I fully agree with Ralph. I think that the emergence of fintechs in retail payments has been very helpful, because that has been an era that has really been neglected both by commercial banks and by central banks. So retail payments, and especially cross-border payments, and most of all remittances that are extremely costly for the people involved. And I think the fintechs, by just providing these alternatives and providing competition to the banking sector, has really forced the hand here on many to work on improvements. And I think that message has really reached commercial banks and central banks.
Thank you very much. I think what's interesting, we're reaching in the debate a bit a point where we're looking a bit on the longer term implications of the crisis. We had a number of questions on this in our chat box, and Jacques Bikundu, if you want to ask your question in this respect, and then have our two speakers reflect on this. Jacques, are you still there? Okay,
thank you so much. First of all, I was trying to ask Ralph, because earlier you talked about loss of tax revenues for some countries, and I was just trying to see if maybe frictionless payments could resolve this issue. Because I remember Anthony Muller just talked about digital currencies, contactless payment, and so that's why we're just trying to see if with Ralph, if it is possible that really the governments, the international organization like IMF can really lead into this policy of establishing, contactless payments.
I'm sorry, I did not get. This is the question was about the fall in the tax revenues that countries are facing.
Yeah.
Could you?
Yeah, that's what. That's
okay.
what.
So the idea there is many of these countries that depend on remittances, the governments have figured out that they don't want to tax remittances directly, because then they disappear. Then you can't see them through the official channels. So, but they know that remittances are mostly used for consumption. So the countries have indirectly taxed remittances through value-added tax, if you like, sales tax, okay, because it's consumed. So now with the drop in the remittances, as a result, there's a drop in consumption. As a result, there's a shrinkage of the consumption base, and with it, the tax revenue that these countries have come to rely on. So as a result, what you're going to see is not only drop in the revenue, but increased volatility in the revenue, which is even more as bad as the drop in the remittances themselves. I don't speak for my organization in this particular setting, but I know that my organization is already engaged with all these countries in terms of shoring them up in terms of fast action, relief, and we're always stand ready to help our member countries in terms of sort of medium to long-term assistance. So already there are over 100 requests for IMF assistance, be it budgetary, be it balance of payments, be it what have you. And the fund is responding. And I know that for fragile states, there are more facilities that are also related to COVID that are also being discussed and in train.
Thank you.
Thank you, Ralph. I still wanted to come back to the more longer term implication. And Michele, you had a similar question on this. Do you want to ask your question here to Thomas and Ralph?
Hello, good evening. Thank you all for the nice presentation. I was just wondering whether we are experiencing a shift spiral that affect all the society. And I have under the impression that this virus just magnify a problem that is already there. And the point is, maybe the market is too strong and the governments and society are too weak to deal with it. How we can leverage or restore some balance in our society, for instance? I would like to hear the opinion of both speakers. Thank you.
Thank you. Thomas, do you want to go first?
I can try. I mean, I think that's an interesting question and totally possible that we had certain trends before, and now through this crisis, they are just sped up. And I think one of these is, as I mentioned, this growing inequality that we have seen that might be worsened now because it's the poorer people who are taking here the brunt of the effect. Also in the markets on corporations, it's the small corporations that really have trouble surviving. And I think it's an interesting question of how does I talked before about the new normal with interest rates, and how does the new normal look after this COVID crisis? So I think solutions, I mean, some of them are clearly, I think, as Ralph mentioned, that we have to again have some risk sharing in the society, because these are shocks that no one really can prepare for properly. And there you need some kind of a risk sharing. It's the same direction as this bond we talked before about, that you basically have some transfers within the society. I think that might be one solution. But there is clearly a risk here that now with the growing inequalities and maybe the debt problems down the road, that this will, and if this not happens, that there will be political reactions to that might be very unfavorable, and I'm a little bit worried about that.
Thank you, Ralph. What's your point on it? Maybe you can reflect also.
Right, I couldn't agree more with Thomas. I mean, I'm right there exactly as what he was saying. Let me kind of nuance it in my own narrative. You know, there's inequality within a country, and there's equality across countries. And what this crisis is doing is bringing it to the fore within and across. So not only are you going to have, because it's not about the crisis, it's about the impact of the crisis, right? If you're rich, you get hit, you can afford a ventilator, you can afford to go to the hospital, you can afford, if you're poor and if you're living hand to mouth and you get hit, what are you going to do? And that's within a country, let alone when you're talking across, you know, fragile states, low income countries that don't even, as a country as a whole, don't even have the means in normal times to deal with crises, let alone with what's going on right now. So, but we have to understand that if we do help the fragile states, we do help the low income countries, it's not because we are good people, we can be. But the point that I'm trying to make is it's in our best interest to help them, exactly as Thomas is saying, because that's why I call it the boomerang effect. Either we stabilize it now or we try our best, or we're going to see something really that I'm worried about, exactly as Thomas, social upheaval at the global level. Because those countries simply are not able to deal with day-to-day. That's why they're called fragile states. They are fragile, okay? And low-income countries could be also fragile. Middle-income countries could also be fragile. So stabilizing them is in our best interest. This is how I would appeal to the policymakers in the rich countries and the high-income countries, that it's not about only us. We're all in it together. We're all in the river with a very strong current, and we're all tied together by a rope called humanity. And we either all, you know, come out of it, or we're all going to sink together. There's no one on the side of the river throwing you a lifeline anymore. This is 2008. That's gone. We're all in it together. That's what this virus has shown us. And we cannot get up ourselves without, we need someone. If we say, well, we can get going ourselves, well, who are you going to sell to? And if you're a tourist country, who's going to come and visit you? One thing about the weakness of the currency, in the old days, we'd say, well, your currency weakens, your exports can benefit. Your tourism gets cheaper. No one is coming and no one is buying. So what this tells you, this is a global crisis. And the sooner we understand that we're all in it together and no one is doing anybody else a favor, the sooner we're going to be. That's kind of from the narrative itself. Now, if you want to funnel down to an action, exactly as Thomas was saying, which is this risk-sharing arrangement, it could take the form of the Eurobond, as France and Germany were saying. They recognize, hey, maybe we can allow countries to use the Eurobond to borrow in order to be able to help themselves get out of it, because the sooner they get out of it, the sooner we can sell our products also to them. So this is just one instrument, but behind the instrument, what you need is the proclivity, the understanding that we're all in this together. And what matters is not the crisis, is the incidence of the crisis, okay? That's where you have to keep your eye on. Where is it? Who is it hitting? And pretty soon we can leave economics and end up in social upheaval, and no one wants that.
Thank you, Ralph. I think these are famous last words, and I think we should leave it at that. I mean, thank you very much to both speakers. It was a great dynamic discussion with both of you, and thanks to our community as well for this insightful question. I give it back to Renate and already say at this point, thank you very much for joining us tonight.
Thank you very much, Eckhard. Thank you very much for your participation today and the very good discussion. Special thanks to our distinguished speakers. We will publish the recorded webinar later this week on LinkedIn. Please join us again next Wednesday when we talk about how to deal with disrupted futures and how scenario building can help organizations better handle uncertainties and recognize new opportunities or possible coalitions.
Thank you, Renate. Thank you all.
In the meantime, please stay in touch with us. You can see the different ways to reach out to us on the screen now. And please feel free to give us feedback on our webinar, comment on our post on LinkedIn, and discuss with us. If you want to become a member of the Geneva Macro Labs or suggest topics we should cover, please let us know. I wish you now all a pleasant rest of the week. Stay healthy and talk again next Wednesday. Goodbye for now, everybody.
Thank you.